What if I told you that one of China's biggest tech giants, Alibaba, could be gearing up for a massive comeback? That's right, there's a real buzz going around. Can Alibaba stock really climb back to $300 per share? Investors are debating it, analysts are crunching numbers, and the market? Well, it's watching closely. So what's fueling this sudden optimism? Is it just hype? Or is there real substance behind this $300 price target? Today on Dividend Dreamer, we're breaking down the numbers, trends, and future roadmap that could either reignite Alibaba's growth or expose the cracks in its foundation. Let's dive in. Lately, I've been getting a lot of questions that all seem to center around one thing: Alibaba's potential rebound. Specifically, can the stock really return to that $300 mark it once touched? And honestly, that's a great question. It's one that forces us to reevaluate our assumptions, look at the fundamentals, and figure out what the next 5 years might hold for this Chinese powerhouse. Now, like any thoughtful investor, the first place many people look is analyst forecasts, the classic 12-month price target. But here's the catch. These predictions often move with the stock, not ahead of it. I've watched Wall Street gradually cut its expectations from $220 to $180, then down to $150. And yet, oddly enough, the rating has mostly remained a strong buy. The price? Not so much. Funny enough, you know what's definitely a strong buy? That like button. Go ahead and hit it if you find this kind of breakdown helpful. Let's get into the facts. An article from Zacks posed a fascinating question. What's stopping Alibaba from getting back to 300? That piece came out around September 2024, and coincidentally, that month saw a surge in Alibaba's stock. So clearly, the idea struck a chord. But most of the analysis out there, it focuses on technical indicators, charts, patterns, volume trends. We're going to look at something more concrete. What kind of fundamentals does Alibaba need to justify that $300 price point? Let's rewind to 2020, when Alibaba hit its peak. Back then, the company posted around $550 billion in revenue, $100 billion in operating income, and $130 billion in free cash flow. That translated to an $800 billion valuation, driven primarily by its core e-commerce business, as the other divisions were still operating at a loss. Fast forward to 2025, Alibaba's revenue has nearly doubled to $1 trillion, with operating income at $140 billion and free cash flow at $74 billion. But here's where it gets interesting. They've retired about 15% of their shares since then. So to hit that same $300 per share again, they now only need a $700 billion market cap, not $800 billion. That's already a 12.5% discount on what it took before. But here's the caveat. While revenue doubled, margins shrank. Operating income only rose 40%, and free cash flow increased far less. What does that mean? The quality of revenue growth wasn't great, likely driven by lower margin businesses. That's why new CEO Eddie Wu is restructuring, shedding non-core units, and focusing heavily on cloud computing and AI investment, two of Alibaba's key growth engines moving forward. So can Alibaba still make the leap to $300 per share? Let's break it down using some reverse engineering. If we apply a reasonable 20x price to free cash flow multiple, that's a 5% FCF yield, Alibaba needs to generate $35 billion USD in free cash flow to justify a $700 billion valuation. At the moment, free cash flow is depressed due to massive capital expenditures, mainly into cloud infrastructure. They've warned this high-spending phase may last 2 to 3 more years. But historically, Alibaba has already hit $30 billion FCF at its peak. So $35 billion isn't a pipe dream, it's within reach. Now let's flip it and analyze via EBIT, or earnings before interest and tax. Using the same 20x EV/EBIT multiple, Alibaba needs to reach $32.5 billion in EBIT. They're sitting on a net cash position of around $50 billion, which helps. Based on their 5-year average EBIT margin of about 13%, that means they'd need to hit $250 billion in revenue. Currently, revenue in USD terms sits around $140 billion. So to reach $250 billion by 2030, they need a compounded annual growth rate, CAGR, of about 10 to 12%. Now let's drill deeper into where that growth might come from. Tmall and Taobao, the legacy e-commerce arms, still generate the lion's share of profit, with healthy margins around 41–42%. However, their growth has slowed. They're not likely to drive double-digit gains anymore, but if they can maintain mid to high single-digit growth, that's a solid foundation. The real story is with Alibaba Cloud. Over the past few quarters, we've seen steady improvement in both revenue growth and EBITDA margins. In fact, Ali Cloud is quickly becoming a core pillar. Right now, its EBITDA margin is around 10%, but peers like AWS and Azure post margins closer to 35 to 40%. Even trending toward 20% would significantly lift Alibaba's valuation. Both CEO Eddie Wu and Chairman Joe Tsai have made bold statements about AI's role in driving all of Alibaba's businesses over the next 3 to 5 years, and the current cloud AI momentum backs that up. If that division continues to expand its margins and compound at 20% plus annually, it could carry the company well past that $700 billion threshold. To wrap things up, yes, Alibaba would need 10–12% top-line growth to return to $300 per share, but that number becomes more realistic if margins improve. And with their renewed focus on efficiency, shedding low-margin units, and doubling down on high-growth tech like cloud and AI, the odds are looking better than many realize. The real wild card? Investor sentiment and what multiple the market is willing to assign to a Chinese tech stock in today's environment. So, will Alibaba cruise back to $300 easily? Or will it have to earn every dollar with consistent growth, fat margins, and aggressive buybacks? Drop your thoughts in the comments. And if you found this analysis helpful, don't forget to like the video and subscribe to Dividend Dreamer for more breakdowns just like this one.